From the Wall Street Journal, office stocks post biggest rally in 3 years. The real estate problems remain. Shares of battered down office landlords had their biggest one-day rally in 3 years last week after inflation data came in lower than anticipated and expectations rose that the Federal Reserve was done raising interest rates. Shares of office real estate investment trusts soared an average of 11.5% on November 14th, according to real estate analytics firm Green Street. That is the largest daily increase since November 2020, when an even larger rally was sparked by the announcement of a COVID-19 vaccine. Some of the most prominent office landlords did even better. SL Green Realty, the largest office building owner in New York, was up 17.4%. Vornado Realty Trust shares soared 15.5% that day. But most office stocks failed to hold all of those gains. The surge in share prices reflected a number of factors, but none that fundamentally changed the long-term outlook for the sector, analysts said. One reason for the rally, office owners are highly leveraged, which looks less burdensome after bond yields fell alongside the lower inflation numbers. Many office shares were also trading around multi-year lows, giving them a lot of room to bounce. Technical trading issues such as short covering played a role too, analysts said. Office landlords still face profound challenges as hybrid work becomes more ingrained and companies cut back on their workspace. Those issues won't be solved by interest rates and inflation returning to more moderate levels. The national vacancy rate increased to a record for 13.5% in the third quarter of this year, up from 9.4% at the end of 2019, according to data from CoStar Group. A record 2.5% of the office space in the market is available for sublease, CoStar said. There's a long road to recovery, said Alex Overby, senior analyst with Cohen & Steers, an investment management and REIT investor with $47 billion in global real estate assets under management. REITs overall outperform the broader market because owners of all property types, including hotels, malls, apartment buildings, warehouses, tend to be more highly leveraged than other companies and benefit more when interest rates fall. When interest rates fall, property values typically rise as yield-seeking investors choose real estate over bonds. But office REIT shares by far outperform the rest, in part because their shares have fallen the furthest. Even after November 14th's rally, office REIT shares were down about 65%, including dividends, since the beginning of the pandemic, compared with down 7.15% for the equity REIT sector, Green Street said. Most office shares have declined slightly since their rise on Tuesday of last week. Many of the investors who purchased office REIT shares on that day were those who had been betting against them by selling short. In other words, they had borrowed the shares in anticipation of the price being lower when they repaid the loans. When the rally began, these short sellers had to buy shares to limit their losses. Short sellers need to close out that trade quickly, explained Steve Sakwa, an analyst at Evercore ISI. If everyone is doing that at the same time, that's what creates a short squeeze, and that very quickly pops the stock. Some quick commentary on the article. We've absolutely seen a nice bounce in REITs recently. Office REITs, which have been down the most, were up the most. That is not surprising. Without a crystal ball, it's impossible to call a bottom in the market. But this is what bottoms often look like, including often being propelled by a strong rally backed by short selling, as investors who had sold stocks that they don't own have to buy back those stocks in order to limit losses. Quite frequently, it actually is a short selling covering rally that forms a bottom in markets. Again, we'll have to see how this develops. But with interest rates driven so much, if we have seen a top in interest rates this cycle, and the 10-year Treasury is down over 50 basis points since getting to around 5% about a month ago, this could actually turn out to be a bottom that holds, and it would be possibly more positive than the article actually alludes. Again, we'll have to see how things develop,